Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's April 25th. It's about 8:06 in the morning. The market's going to open up in about an hour and 24 minutes, and I hope each and every one of you had a wonderful, wonderful weekend. Now, as you guys could see, the Dow's opening up, or probably will open up, down about 230 points. The Nasdaq's down about 100 points, but I was looking at everything this weekend, and I'm going to tell you, you're probably going to think I'm crazy, but I'm seeing the market make a nice big reversal. Let me explain to you why. There are several reasons why. Number one, bond market. The market's opening down this morning, right? We're down about 235 points, 100 points on the Nasdaq, and this is following a nice big, let's see, what do we have? A 900-point drop on Friday? Yeah, 944 point on Friday. We're right now post-market down another 200-something points. We're all the way down here. We clearly broke this level, which I was hoping we wouldn't, but we did break this level. But the interesting thing is this. Here's the interesting. Look at the bond market. The bond market is up. It's not down. Now remember, historically, when stocks go down, bonds go up. Bonds have been going down with the stock market. So we haven't seen a lot of flight to quality. That's because the Fed is very aggressive in terms of raising rates, and they're predicting they're going to raise rates half a basis point instead of a quarter of a basis point, potentially at the next meeting in about a week and a half or about 2 weeks. But notice the bond market, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 2 weeks now, the bond market has been choppy. It hasn't been moving lower. That's a very, very, very positive sign for the stock market. That's a sign that the long bond does not see itself going lower, which means most of the interest rate fluctuations that the Fed is trying to pass our way are priced into this market. I'm going to repeat that one more time in case you didn't catch it, because it's very important. The fact that the market is sideways when we already know that the Fed is ready to raise rates, and taken into account with the fact that the bond market went from 155 to 121 is a very, very, very strong indication that the bond market is pricing in what the Fed is anticipating to do. And if the bond market's pricing it in, then it's mostly priced into the stock market. That's number one indicator. That's indicator number one. Here's the other indicator, the put-to-call ratio. The put-to-call ratio is at 130, okay? Now, let me show you the last time the put-to-call ratio was at 130. Let's go back. The last time the put-to-call ratio was at 130 was, or right around this level, the highest level we have till now, was during COVID, during the COVID crash. Right here. Look at this. February 24th of 2020, March 2nd. That's the COVID crash. Below then, the last time we had it was in 2018 when the Fed raised rates. So this doesn't happen very often. And typically after we see this type of trading action, the market rallies big time. So again, I can't predict the future and I don't have a crystal ball. But the fact that the number of put buyers to call buyers is this extreme is telling us that the market is going to turn around and head higher very, very quickly because it just can't sustain this level of volatility. So the two major factors is the bond market and put-to-call ratio. To a lesser extent, to a lesser degree, we've got VIX, which is now at 30, and I don't think we're going to get much more of a rally from this thing. I'm actually thinking of selling it right now or buying a put, because I don't think volatility is going to increase. I think if with the put-to-call ratio, with the market down this much, we're in the middle of a war, and if we can't get a bigger reaction than this from the VIX, then what is there? I mean, what's the market going to do? We got earnings coming out. We've got most of the negativity already priced in. We already know what the Fed wants to do. It's already well priced into the bond market. It just doesn't seem like things are as bad as they seem. Now, let's talk about global economy. This week, the big report for the week is going to be GDP. That's going to be extremely instrumental in whether or not the Fed raises rates half a basis points or not. If our economy is still really, really slow, they may say, hey, we can't tolerate the economy can't handle a half a basis point. But if the economy is overheating, they're definitely going to say half a basis point. That's a huge, huge report for the week. Another big report for the week is consumer confidence. So consumer confidence, remember, consumers make up 2/3 of the GDP. So consumer confidence is going to be a very, very positive reflection on the GDP. And then we have consumer sentiment, which is absolutely useless because it's already after the GDP and consumer confidence, but the Fed insists on putting it here. So you've got a lot of good reports this week. We've got durable goods, we've got consumer confidence, new home sales. I don't think that's going to be big. Maybe for future, maybe because of interest rates are going higher, but I don't think that's going to be a big ticker there. Personal income as usual, jobless claims is going to be a no-brainer because those numbers have been steady. GDP, international trades in goods and services, consumer confidence, and durable goods. Tomorrow, starting with the big news on durable goods and consumer confidence during market hours. Now, we've got earnings this week. We're now fully in earnings. We've got a lot of consumer staple and non-tech. Last week was about financial. Now we got consumer staples and a little bit of banks trickling in. Packaging Company of America, Coca-Cola, Whirlpool, meat and potatoes type of companies, Bank of Hawaii. Not huge companies reporting today, but there are some big stocks that are reporting. And there are a lot of big stocks reporting this week. We'll get into that as the week progresses. But keep your eye on Coca-Cola today, 58 cents a share. Keep your eye on Whirlpool, $4.82 per share. And keep your eye on SBA Communications because communications have been getting hit really, really hard. A dollar they're expecting. Now, let's talk a little bit about positioning. Dow Jones, I think we're going to bounce off of these levels, and I think we're going to start heading a little bit higher. I would expect that to be the case since the RSI level is getting down there. On the QQQ, let's see what that level is. On the QQQ, looks like we're also bottoming out, and RSI, we're already below 30. It just doesn't look like we're going to go a lot lower, maybe just a hair, and then start coming back up. And on the SPY, looks like RSI is below 30 as well. It just doesn't look like the market is going to go much lower right now. It looks like we're going to be choppy, very choppy, but with the put to call ratio and with the volatility not looking really, really low, it looks like we can get a nice juicy rally from this market right now. Let me give you a sector analysis so you guys could see where we're at in terms of sectors. Always do this on Mondays because you never know which sector is going to lead. No news here. Energy, utilities, consumer staples, real estate. Keep your eye on consumer discretionary. On a monthly basis, consumer discretionary and tech are still far apart, which means the market is fragmented, but you probably didn't need me to tell you that. You could probably figure that out based on the fact that the Dow lost 900 points on Friday. When markets go lower, they get a little fragmented, and then when they get overdone, they start getting tighter. But right now, we're still fragmented. Looking at the charts, consumer staples had a nasty down day on Friday. Real estate is lower. Utilities looks like it's ready to break lower, which is kind of odd because that would happen if energy prices are going to break lower. But I don't know if we're ready for energy prices permanently to break lower. Consumer discretionary, we've got to watch it carefully, although I got to say it's holding on really, really well. Industrial broke down, but consumer discretionary actually held at the 5-day level or 10-day level here, which is pretty remarkable. Healthcare had a nasty, nasty day. Basic materials had a nasty day. Basically, the market was just very low. Expect a pullback this week. I'm not expecting this type of trading action to continue for too many more days. Looking at global economy, just a few things. Interest rate hikes dominated array of investors' concerns. That's one of the reasons why the market dropped so much because the Fed is not talking about half a basis points, and earnings have not come out as expected. Even oil slipped $4 a barrel. Macron won the election, which means that Ukraine and France are not going to be far apart in the next couple of months. Hong Kong internet company Baidu slumped 7%. PetroChina, which is one of their biggest oil companies, I was actually looking at this company last night, down 4%. Rising COVID cases in China are setting off worries about the pandemic and the fact that America is looking back to a non-lockdown summer. That's what may be impacting that. That's what I would be focused on right now. That would crimp economic recoveries in the region, and we're hoping it's not going to move away from China. But remember, China is a huge exporter, so this could be a major, major issue. Investors are watching profit from companies, including Japanese big names that are coming ahead this week. Several reports from U.S. companies have been released, and they've been disappointing. Some have been good, though. What the Federal Reserve might do is high on investors' minds. The chair of the Federal Reserve has indicated central bank may hike short-term rates by double the usual amount. Why not, right? The market doesn't have enough stress to deal with. Starting in 2 weeks, the GDP is going to be very, very instrumental in that. Keep your eye on that report. Very instrumental in what the Fed is going to do. The Fed has already raised its key overnight rate once, the first such increase since 2018, and the market has been on fire. Markets around the world are feeling similar pressures on rates, inflation, particularly in Europe, as the war in Ukraine pushes up oil, gas, and food prices. Keep your eye on volatility. I think volatility is going to peak this week, and I think we're going to move lower on volatility. I think the S&P is going to move higher. I think we're going to bottom out at these levels, and we're going to go higher. And I think the Dow Jones, may actually regain some of its composure as we move higher. But the market is really overdone. And again, with the put to call ratio, as I showed you, being near 130, which is crazy high. I mean, look at this. Look at this. This is the highest level we've had in 3 years. Let me look at 5 years. No, we've had higher levels. The last time we had levels like this was in December of 2018. And then March 2018. We haven't had these levels, these put to call ratios in a while, which means investors are really turning to puts, and that means markets usually flip. So again, that's the prognosis this week. Keep your eye on the major indices. Keep your eye on the Dow Jones. And most importantly, if we break these levels, if we can go back up, volatility is going to decline very quickly, and we'll get out of this mess. And I think if earnings start picking up, we'll be in good shape. Keep your eye on the Fed. There's going to be a lot of volatility this week. Be defensive. Don't overstay your welcome, and don't bet everything on red. Be careful, diversify, watch your risk. This is a do or die environment where we have to watch our risk very carefully. Now, folks, tomorrow is going to be a very, very, very special day. 10-time trading champion Chuck Hughes, he'll join me live for the grand reveal of Takeoff. During this special event, Chuck will make his boldest prediction to date and give attendees a set of stocks that he believes could take off in the coming months. Just so everyone knows up front, Chuck follows facts, not emotions. He's just like me. He follows facts. And he believes we could be setting ourselves up for a windfall of a decade. Click the link below to learn more about Takeoff and register for tomorrow's event. You guys are going to love it. And tomorrow we're going to be talking about strongest sector, strongest stock, weakest sector, weakest stock. You don't want to miss out. If you enjoy these videos, if I'm benefiting you, send me a letter, support@marketgeeks.com. It doesn't cost you anything, and I'd love to get your feedback. Bye. Have a great day, and I will be with you every step of the way. And remember, we've got earnings. Bye, guys.